Welcome to Retirement Rescue Radio, a show specifically designed to help retirees and pre-retirees maximize their financial efficiency so you can live the retirement lifestyle you've always imagined. Your host is Nate Miller, investment advisor representative and author of the CPR Retirement Rescue Roadmap. Nate discusses thoughts and ideas from some of today's most knowledgeable professionals in the field of finance. He offers strategies along the way to help you make better financial decisions so you can maximize your retirement. This is Retirement Rescue Radio.
Well, hey there, everybody. Welcome to another episode of Retirement Rescue Radio. And today we're going to go over a couple articles. These come to me pretty much every week. There's a gentleman by the name of Michael Kitces that puts out a ton of content and training for financial advisors. And this is his weekend reading for financial advisors. And we're going to go over a couple different articles here. One of them comes from Think Advisor, and it is about consumers keeping more cash on the sidelines right now. And the other one is going to be from The Irrelevant Investor, and it's why I took money out of my house, talking about refinancing. And so a couple things that I want to go over here, and I think are pretty timely because the consumers are keeping more cash on the sidelines. That one is because, the consumers have been facing a lot of financial headwinds in 2022, from weak stock market performance to elevated levels of inflation, which consequently make those real investment returns even worse. And so a recent survey suggests that consumers are keeping more cash on the sidelines against this economic and market volatility. So there was a survey of just over 1,000 different American adults by Allianz Life, and it found that 65% of the respondents said they're keeping more money than they should on the sideline out of the market because of worries of loss. And that is up from 57% in 2021 and 54% in 2020. So 65%, that's 2 out of 3, basically. 2 out of 3 are keeping more money on the sidelines because they're worried about losing money. And so, in addition, 60% of those surveyed said that they think that it is important to have some retirement savings protected from loss. I would also agree with that. If for those of you that have listened to any of my podcast episodes, especially the 3 investment worlds, you know that there is definitely a portion of our clients' plans that involves principal protected accounts. And that is absolutely the same thought process here. Is there should be some retirement savings that are protected from loss. And similarly, a lot of respondents have a pessimistic investing outlook, with only 25% saying it's a good time to invest in the market right now. And that's down from 37% in the fourth quarter of 2021. And so here's an issue that I have sometimes. So this is why sometimes investing is counterintuitive. Even I think it's, Warren Buffett was the one that said that, be greedy when others are fearful, and fearful when others are greedy. And so sometimes investing is counterintuitive to our first inclinations, our first emotions, right? Because right now, when we see the stock market go down, our first emotion that probably comes up is fear or uncertainty. There's if you're on the latter side of life and you're actually taking money out in retirement, well, then yeah, this might not be a good feeling. This could be bad depending on what your financial plan is. If you don't have anything that's principal protected and safe from market declines, maybe this is a very worrisome time for you. For those of you that do have a lot, and for a lot of my clients, because that is a key component of our financial planning, is you do have a lot protected. And so when you hear the market or articles or news talking about how the market's down 15%, 20%, we've entered a bear market, that's not necessarily what your reality is. And I would say that for any of you that are out there, whether you're a client of mine or not, is when you're listening to the articles, what is your reality? That's a first step that I would take when thinking through this. What is your reality? Are you also down 15 to 20% on all of your assets, not just on a portion? Because there could be a portion that's down, quite a bit if it's invested aggressively. There could be a portion that's down a little bit because it's a little bit more conservative. But if you also have some of those principal protected accounts, those might not be down at all. And so, so there's that. So you have to take into consideration all of the buckets of money that you have for retirement, not just some of the buckets that might be, subject to market risk. For example, let's use easy math. Easy math. Let's say that my clients were 50% in principal protected accounts and 50% into the market. Well, that means that if the market does go down 20%, and let's just say that we are, quote, all the way in the market, and let's define what the market means, the S&P 500. A lot of people, when they say the market's up, the market's down, usually they're talking about the S&P. So let's just say that you were invested in an S&P index fund and it was down 20%. That was half your money. The other half is principal protected. That other half did not go down at all. So your total portfolio is really only down 10%. And so a lot of people, that's still well within their comfort level when it comes to risk. But they might be looking at some of those things in the market and saying, oh, I'm down 20 on that. And so this is, considering we're not even well diversified, we're just all in the S&P, right? Which that's not really what should be happening in retirement anyway. And so, yeah, that would be what you're down 10%, not 20. So don't just look at one chunk of your money and think that reflects your entire portfolio value. Now, so that's the first thing I would say. Two, I would say if you're on the other side, if you're on the not the latter side of investing, but you're on the beginning of investing, or maybe you're in your 20s, you're in your 30s, you're in your even 40s, really, that statistic right there saying that 25%, only 25% say that it's a good time to invest right now. That should be 100% of you guys, because you're still accumulating your wealth. You're still putting money in. And when the market goes down, let's say the market goes down 20% and you're putting money in. Well, in my opinion, this is completely my own opinion, especially if you're invested semi-aggressively, which in your 20s, 30s, and 40s, you kind of, according to my opinion, you still should, because you just need that money to grow and be a huge hunk of nest egg by the time you retire. That's what you need. And so 25% thinking it's a good time to invest right now should be 100 if you're on that side of the coin, if you're on that side of the investing coin, right? Because 20% down and you're putting money in, that's almost a guaranteed return of 20% sometime in the near future. Again, that's not a guarantee, all right? Can't use that word, but in my opinion, it's almost as close as you can get to one, because we already know that the market has proven that it can get to that point. And so that's a lot of how I invest. I'm on the accumulation side. I'm not planning on retiring anytime soon. So if there's any of my clients that are wondering that, I'm not going to retire anytime soon. I'm only in my early 40s right now. And so that's what I would be doing. That is what I do, actually. So since I don't get a steady paycheck, I'm not a 9-to-5, or I own my company. I don't have every 2 weeks money going into a 401k or something like that. So a lot of times what I do is I strategically dollar cost average. Everybody else is just dollar cost averaging just automatically, because every 2 weeks you get your paycheck, a piece goes into your 401k. So you're buying shares up, you're buying shares when they're down, you're averaging, your dollar cost averaging in. Well, right now you're buying a lot of shares at lower prices. So you're actually buying more shares. Well, when those shares start going back up in price, you're going to end up making that gain. So you have some that you probably bought at the top of the market and you've just bought periodically, you've averaged in all the way down. So what I'll do is if the market goes down about 5% from its most recent high, I'll throw more money in. And then let's say it keeps going down and all of a sudden now it's down 10% from its high. Well, I'm going to put more money in. This is pretty much almost exactly what I did from the beginning of January. And then the market kind of vacillates for a little while and then it goes down even more. Throw more money in, right? That's what I've done. Now, did I finally throw money in at the absolute trough when it was down the most? No, I didn't. Because market timing is very, very difficult. Nobody knows where that trough is. Heck, we might not even actually have hit that trough yet. It's bounced a little bit, but it may go back down. Nobody has that crystal ball, right? I hope it keeps going back up. But if it doesn't, am I mad that I didn't put money in right at the trough? No, I'm not, because I know that I'll just wait a little bit longer and eventually it's going to be coming back up, right? The statistics that we have, we know that markets end up going up and markets end up going down. It's cyclical. And right now they're down. And so what we should actually be doing is recognizing that first emotion that we have of fear or uncertainty. And again, think of Warren Buffett with be fearful when others are greedy and greedy when others are fearful. Well, people are fearful now. Stocks are kind of on sale at this point. This should be a great time to invest in the market. So knowing that only 25% say that it's a good time to invest in the market, Was it a better time to invest when the market was at all-time highs? No, it's better to invest when it's lower because buy low, sell high. That's how you make money in the stock market. Just keep it that simple. And so since the market is low, buy. That is kind of what, according to that, not that logic, that's what should be happening. So I'll say that for those that are on the accumulation side, all of you should be realizing, hey, this is a great time to put money in. All right. Now, so continuing on in this article, inflation continues to weigh on the minds of a lot of consumers. 82% say that they worry that inflation is going to continue to have a negative impact on their purchasing power in the next 6 months. And 71% say that their income is not keeping up with rising expenses. So now that means that, and it doesn't tell in this article what the demographic split was of all of these 1,000 adults that were surveyed. We don't know if half of them were under 50, half of them were over 50, or how that split. We don't know that. And so I would say that it does have some of the millennials that were recorded in this survey. And they said that, just over half of them say that they actually do have an effective financial plan in place to help address rising costs of living. And so that suggests that a lot of younger Americans, so if it's just over half, then that leaves just under half of millennials that could benefit from working with an advisor to create some type of plan to help combat inflation. Now, we work inflation into every single one of our financial plans. And what we found, based on a lot of studies that have come about, is that the year over year inflation numbers don't matter nearly as much as what the long-term inflation rate is. So it's going to be painful here maybe for a couple of years, but what is that long-term inflation rate? Long-term inflation rate here recently has not really been that high. We've kind of been spoiled for a while. It hasn't really been that high. And so now all of a sudden we're having super high inflation. So that's really got us worried. So if that is a concern of yours, then maybe reach out, get some time on our calendar. 15 minutes is what that calendar link will get you. It's 15 minutes of time with me to find out whether or not we need to go any further, find out if the concerns that you have are founded, unfounded, and just maybe get a little bit of an idea on where you stand. And so therefore we might even be able to help put you in a better position going forward in case this type of inflation or, a volatile market comes back again. So I'd say that. So overall, this survey, it suggests that consumers have a broadly pessimistic view of the economy right now, and that is affecting their investment behavior. And so whether it's having a conversation with us to see how you might be able to combat that, or just maybe helping you guys find ways of getting some of that cash off the sidelines and where to invest it. So advisors can help play a pretty important part in ensuring that the clients have a long-term financial plan that remains intact and on track despite any market downturns like what we're having right now. So I'll move off of that one for a second. Obviously, if anybody has any questions on that, you can either schedule some time with us by clicking on the calendar link and getting 15 minutes, or just emailing us at asknate@retirementrescueradio.com. And if you do that, there's a good chance that your question may actually get read online or on air as well. And so obviously we'll change the names to, protect the innocent and all that stuff. So there's that one. Next one is why I took money out of my house. So we're talking about doing a refinance on your current house. And so the decline in mortgage rates from, I'd say, about early 2018 to even 2021 gave a lot of homeowners the opportunity to refinance those loans at a lower interest rate. And while most of those mortgage holders, they simply just refinanced their current balance, right? So what they basically did was reduced their monthly payments thanks to that lower interest rate and lower loan. Some of them, though, took advantage of the rising home values by electing to engage in what's called a cash out refinance, or sometimes in the real estate industry, you'll just hear it called a cash out refi. So now not only are they refinancing their outstanding mortgage balance, but they're also generating additional cash by taking out a larger loan. For example, let's say you bought your home at $100,000 at, say, 4% interest, and then it has grown to 200,000, whatever it is. You bought it for 100 and it grew to 200,000, let's say that. And now you've got equity. Let's say the mortgage balance is 50,000. So you've got $150,000 of equity in your home. You could simply take out another loan for $50,000 and thereby lower your monthly payment, or you could do that cash out refi. You've got $200,000, $150,000 of equity. So usually people will do about a 70% loan to value on the cash out refi, some places 80%, right? Depending on the situation. And so let's say it's a 70% loan to value. Well, that means a $140,000 loan is what you can get. And so now you've got a $50,000 mortgage. So the difference between 140 and 50, so you're getting about $90,000 of cash. Let's, closing costs and stuff like that. Let's just take that completely off the table and say that you're going to get about $90,000 by doing that cash out refi. And that's also could increase the cost of your monthly payment too, but now you've got $90,000. So that is a cash out refi. And so there was a specific person that they're talking about here. This guy's name was Michael Batnick. There we go. And so he originally had a 30-year mortgage at about 4.6% interest, but as interest rates declined in 2020, he actually refinanced to a 15-year loan at 2.875. So awesome rate there. And then as the housing market heated up last year in 2021, the value of his home also appreciated. So that gave him the option of tapping into the equity of his home through that cash out refi. Now, doing this requires trade-offs. In his case, it included moving to a higher interest rate. So he went from 2.875 to 3.375, and that it now is extending his loan over 30 years instead of 15. And so what he did was he consulted with his advisor to determine what type of investment return that he would need to come out ahead. And this turned out to be somewhere between 4.5% and 5% in his case. And so he decided that the liquidity and the flexibility gained from the cash out was worth the risk, and he went through that refinance. And so in the end, some can view cash out refi as a smart risk, especially when mortgage rates are pretty low, providing the opportunity for significant upside if the invested funds do well, while others might prefer to have that smaller mortgage and lower monthly payments. And some, they love the peace of mind of just having a paid off house. You don't have to worry about any kind of monthly payment. So there are definitely pros and cons to this. A couple of the cons it just mentioned there. Obviously, the pros, you got that increased flexibility. You could invest that money. And in his case, like I said, it turned out that he needed about 4.5% to 5% in order to come out ahead by making that move. And so this is all going to be completely personal. There's a lot of people that I would not recommend do this because here's the danger of doing the cash out refi. If you are not disciplined, then you might just treat your home as an ATM machine. And that's when a lot of people get in trouble. If you get to retirement and you've got all your debt paid off, the only debt with the exception of your house, that's all you've got left. You don't have much on there. Maybe it could work for you. But if you're in a situation where I'll keep the numbers a little off here and won't name any names, but we had someone come to us that they had a house that was worth maybe about $250,000, and they bought it originally for $58,000, but they currently have an $80,000 mortgage on it. Not only that, they have a lot of consumer debt as well, and such that they're not going to even come close to having that consumer debt paid off before they want to retire. They want to retire far too soon, in my opinion, for their financial situation. And so that's going to be a case of think about that. If they bought the house for $58,000 and they have an $80,000 mortgage on it, what happened during that time frame? Well, they kept doing a cash out refi. They treated their home like an ATM, and knowing that they have a lot of other debt outside of the home, this is a trend for them. This is a financial thought process that they have. This is an undisciplined thought process or a relationship with money is what this is. And so, like I said, that's a situation where I don't want to see that. But like I said, if you have no other consumer debt, no credit cards, maybe your car loans you don't have any car loans or very, very small, and you're able to make your monthly payments pretty simply. Yeah, all these situations are going to be individual. But in the case of the situation that I just mentioned, I absolutely would not recommend a cash out refi for this person, because that's just going to put them in a much worse position. They even wanted to know if they should take money out of their accounts to pay off that amount, to pay off that loan. And I'm like, knowing what normally happens when you pay off a loan and you haven't corrected the behavior that caused that debt, you're just going to fill those credit cards right back up. And now you're going to end up owing more, and you've got the higher increased payment on your mortgage. So yeah, there's all kinds of issues that can come with this. Make sure that if you're in the case of thinking about doing this, you're more on the case of you've got good discipline. You don't have a whole lot of other debt outside your mortgage, instead of this is kind of a trend and has been something that you've been struggling with, throughout your entire working career. So that is some of my thoughts on these two articles. If you have any questions, or maybe you find yourself in any of these situations, just like I said, just go ahead and reach out or send an email to asknate@retirementrescueradio.com. Our link will be here in the show notes or the description, wherever you're consuming this, whether it's through iTunes or whether it's on YouTube. And so, guys, that's it for today. So just trying to bring you some more content and thought process and perspective around some certain things that are going on right now to help empower you to enjoy the retirement that you deserve. So take care. We'll see you here in about another week or so.